Hey everyone, welcome back to another episode of the Two Idiots podcast. It's your host Ravi here. On the other side is my co-host and good friend Ruben.
Yeah, hi everyone.
Hey Ruben, how was your Tuesday?
Yeah, Tuesday is not bad. So
Cool.
yeah,
All right. So what are we going to talk about today?
so today we will talk about discounted cash flow for Walmart. So last few episodes, we did this for some semicon and some software business.
Hmm.
Now we just want to explore this, the retail business in Walmart. Yeah,
Absolutely. Let's get into it.
yeah, sure. So let me share my screen. Let me know when you guys can see it. Yeah,
I can say it.
yeah, sure then. So yeah, I mean the best source of information about any company is their investor relation. So you just go to the investor relation, then look for their latest financial releases, quarterly releases or annual releases, and then just go into the data, and then you can dig out the data. So we actually went into their investor report. Then we tried to understand these numbers, and then we pulled out the necessary numbers for our discounted cash flow analysis, and also we did some cross-checking of these values against what's in Morningstar. So with those numbers, we just actually plug the data into our the standard template to estimate the free cash flow for pretty much any business. So what we assumed here, so it's not something that we assume. So we just take from analyst estimates as well as what we see as data in the Walmart's financial statement. So we estimate, so that we plugged in a growth rate of around 5% for the first 5 years, and then the following 5 years around 3%.
Yeah.
So Walmart is actually, yeah, you want to have a comment on the Walmart growth rate? So it's sort of consumer business, that grows along with the GDP of the country. Basically, you don't expect them to sell 25% more or 30% more in the next quarter.
That's right.
It will just go up steadily. Yeah. So and then the prices go up along with the inflation. Then the revenue also reflects those numbers. So and then we took a conservative discount rate of around 10% for this business. And then if you had seen our last video, we put 25 times free cash flow, for the terminal value. But for this one, it's a low margin business, so we just put a lower value of like 10x the free cash flow. So and then
Yeah. Just
yeah,
one thing I want to add here, guys, is yeah, if you look at a tech business like Microsoft or Amazon or Google, right? So these are wonderful businesses because they take in very little capital investments, but at the same time they provide a lot. They produce a lot of profits and free cash. But a
yeah,
business like Walmart is extremely capital intensive because you will generate cash from operations, and you'll have to reinvest a significant part of that in growth initiatives. So, Ruben, we were reading just before this call that Walmart is investing in initiatives like warehouse
yeah,
automation, expanding existing warehouses,
yeah,
like buying vehicles for better
yeah,
deliveries and so on. Yeah.
yeah. So actually, those guys explained the free cash flow information, what they were investing on, over here.
Yep.
Due to increase in inventory cost and then purchase to support strong sales, lapping the impact of. So, they will actually give you the reason, for
Mm.
those numbers they're providing.
Yeah, so that's the
So,
reason we've taken a lower multiple than our previous DCFs.
yeah, yeah. So we just plug these numbers, and then these values will generate the free cash flow for the following years, as well as the present value of those free cash flows. So as we always follow, so for the year 10, so we take the multiple, the terminal value multiple, and then for the present value of future cash flow, we just add them all together from here to here. So we get around 147 B, and then we just add it with the cash in hand, which is around 14.7. And then we saw on their balance sheet that they have close to 50 B in debt. So, and then we subtract that value from the overall value. So we get an equity value of around 114. So we have to put in the actual stock shares outstanding, Ravi. So it's not actual value. So this one, I forgot. So let's just go back to their balance sheet, and then we just try to find shares outstanding. So they have 2.8 billion. So it's going to significantly adjust our valuation. So 2.8. So the share price comes down to 40 $40. So now the current price is around 136. So it's at 2.3x premium. It's trading at 2.3x premium. So now we want to see at what value it actually makes sense, at what growth rate or what multiple. So we just bump this number up to 15% growth rate. And then for the following years, we just bring it down by like 10. So it's still trading at premium. So why don't we just make both 15? It's still going at premium. So this one goes at 20. Then the other one at
15.
Yeah. So actually, we are actually getting closer. So just go 17. Yeah. So at 2017, it actually makes sense for this business. So which is never going to happen. So
And Ruben, there's one more thing I want to try out.
Yeah.
But before I do that, can we go back to the initial growth rate assumptions? What was it? 5 and 3?
Yep. Yeah.
Okay. Yeah. So I was just thinking when you were speaking that Walmart. So even though it's a retail company, it's in the business of retail. It has a very strong brand and it has a very strong moat. So I'm thinking, if you sell the whole business, you should net at least, I guess, 15 times last year's free cash flow. So let's see what happens if we, plug in 15 instead of 10, if that's okay. Okay. What about 20 times and 20 times free cash flow? Okay. We are still not there yet.
Yeah.
Okay.
So, but one good thing about this business is these guys are buying back shares quite aggressively, right?
They are,
based
yeah.
on the
They're since 2009 till now. Every single year, they've reduced the number of their shares by buying back shares.
Yeah. So yeah, so this value is actually like going down basically. So that's what we are trying to say. If it goes down further enough, your stock price will automatically just keep going up, even though there is no change in the fundamentals, basically.
Absolutely.
So yeah, but these guys also pay dividends, right?
I think they do, but in a free cash flow, in a DCF, we assume that the company pays no dividends, or if it pays a small dividend, we just exclude it.
Yeah. So this is the story. So according to these numbers, this stock is significantly overvalued. So you could actually consider looking into this one if it hits around 62, $60. That should be like a good entry point. So even we just keep five, it just goes along with the inflation.
Yep.
So it's still $70. Yeah. So, but if those guys keep buying the shares back, then so it will keep going up. Yeah.
Yes, because you'll have ownership of to a larger part of the free cash flows.
Yeah.
As the share count comes down.
Yes.
All right. That was a good valuation. Anything else to add, Ruben, from your side?
I think that's it. So we can actually call it a day.
Okay.
It's
sounds good.
12:05.
Yep. Sounds good. Hope you guys enjoyed this. And if you want us to value other companies and have more interesting discussions like this, please leave comments below under the video. And yeah, Ruben, as usual, I'm just going to leave a link to this sheet in the video description. That's all, guys.
Sure.
Yeah, thank you.
Thank you.
Yeah, and
Have a good night or good day. Yeah.
have a good night or a good day, depending on where you are. Take care. Bye.
Bye.